So this is chapter 13, part 1. This is our final topic for this semester, and it's entitled the cash flow statement. So the cash flow statement is one of the integral financial statements. We think about it. First of all, we have the income statement, we have the balance sheet, and we have the cash flow statement. We also might have the statement of shareholders' equity or the statement of retained earnings. That's really just a bridging statement. But these are the primary financial statements that we're going to use to analyze a company's performance and financial position. And the cash flow statement is an extremely important statement. And we'll talk about that in a moment. But just to kind of refresh our memory, if you remember, the income statement is focused on one of the objectives of the company, and that is, of course, profitability. So if we want to understand profitability of the company, we would look to the income statement. That's going to show us the revenues, the associated expenses, and what our profitability has been for a specific period of time. The balance sheet, on the other hand, we would look at the balance sheet so that we could understand a firm's liquidity, among other things. But liquidity, of course, being, can we pay our short-term, or can we satisfy our short-term obligations? Can we pay our short-term bills? And liquidity will tend to be the ability to, or will oftentimes, we will look at the resources that we have versus the liabilities or the amounts owed. So that's typically how it's looked at. Now, obviously, these are two different things. Just because we're profitable doesn't necessarily mean we have liquidity, and vice versa. And I think the first week of class, the first meeting, we talked about the fact that these are different things. That just because we're profitable doesn't necessarily mean that we have a large bank account. And an example of that might be in a personal situation where we might make a lot of money. Maybe our salary is high. Maybe we've made a lot of money. But at the end of the year, our bank account is very low. Or in the case of some people, they seem to make a lot of money, celebrities, athletes, and yet at the end of the year, they might be actually bankrupt. So again, profitability is completely different than liquidity. Now, obviously, you need to have profitability over the long run to have liquidity, but just because you have profitability doesn't necessarily mean that you have liquidity. Now, the question is, okay, I was profitable, but I have no liquidity. So what happened in between that? How did I get from here to here? And the way we're going to understand that is through use of the cash flow statement. The cash flow statement is going to tell us what were the sources and the uses of cash throughout that period of time. In other words, what was the change in the cash balance from one period to the next? So that's really what the cash flow is intended to address. So if we have $100 in cash in our bank account and we made $50,000 in profit, and at the end of the year we have only $10 in cash, what happened? Where did that $50,000 go? And the cash flow statement is going to be able to tell us, where did that $50,000 go? It's also going to be able to tell us what else happened that affected cash. Did we borrow money? Did we spend money? Did we repay our borrowings? Did we issue any stock? Did we purchase long-term assets, etc., etc., etc.? So the cash flow statement is extremely important in terms of understanding what happened throughout the period from a cash point of view, because ultimately cash is what's needed to pay the bills. And if you remember, if any of you guys watched the Enron extra credit documentary, you'll remember that that was one of the issues that people had with Enron. Enron did not produce a cash flow statement during the year. So on a quarterly basis, they did not supply a cash flow statement. So investors were really left in the dark as to what was really going on with that company. And it wasn't until year end that they tried to piece things together. And at that point, it was too late. So that was one of the big contributors to the fraud and why the fraud continued on for a period of time. So that's what we're going to do. We're going to look to see what's the change in cash and what were the sources and what were the uses of the cash over that period of time. And that's going to help us to bridge the income statement to the balance sheet. So that's what we're going to do. Cash flow, sources and uses of cash, change in cash, balance. Okay? And the way we're going to look at that is they're going to look at 3 different activities. We talked about this in the first class meeting. The 3 activities the company is involved in are operating activities, investing activities, and financing activities. And that's how our cash flow is going to be set up. So operating activities are the day-to-day operations. Investing activities are anything that has to do with long-term assets. So that would be either purchase or sale of long-term assets. So either we're buying long-term assets or we're selling long-term assets. Any cash associated with those activities would be included in investing activities. And financing would be anything to do with long-term liabilities or any transactions associated with shareholders' equity. Now, excuse me, in the day-to-day operations, we're also going to include, that's going to include obviously everything that goes into net income. So the way we're going to approach the cash flow is we're going to look at changes in the balance sheet. And that's going to help us address what has been going on throughout the year. If we account for all the changes in the balance sheet, then we will have accounted for all the changes in the cash. Because ultimately, cash is one of the accounts in the balance sheet. And if we account for all the changes in all the accounts, we'll have accounted for all the changes in the financial position of the company. So that's what we're going to focus on. So for operating activities, we are going to be focused on all the changes in current assets and current liabilities and net income. For investing activities, we're going to be focusing on all the changes in long-term assets. And for financing activities, we're going to be focusing on all the changes in long-term liabilities and shareholders' equity. So if we account for all of these changes, in other words, if all of the changes in all of these accounts are reflected on our cash flow, then we should end up with the change in the cash position of the company for the period. So that's what we're going to want to make sure. We're going to want to make sure that we have accounted for every change in every balance sheet account. If we do that, then we're going to have everything in our cash flow, and the resulting balance is going to be the change in our cash balance. And that's, of course, what we want to get to. So that's how this is going to work. Okay, so one thing, so let's come back. I'm going to just lay out the format, and I'll do that right now. All right, so how are we going to put together our cash flow statement? What I've done is given you a format for what it's going to look like. So we're going to have a statement of cash flows, and then we're going to organize it as I mentioned. We're going to have the first category is the cash flow from operating activities. Second category, cash flow from investing activities. Third category, cash flow from financing activities. And the sum of all those should give us the increase or decrease in cash. And that will be from year to year. The change in the cash balance will be that amount. And so what I'd like you to do is actually go to the textbook, and over on the right hand side here, I've put a page reference, page 634. Page 634 shows you a balance sheet. And what they've done is they've showed you 1 year balance sheet, and right next to it is the prior year. And then they went ahead and calculated the differences between the 2 years for all the balance sheet accounts. And so that's how we're going to put this thing together. We're going to basically lay the balance sheet years side by side. And the first thing that we're going to do, number one here, is we're going to calculate the change in the balance sheet accounts. Okay, so once we've done that, we've got all the changes in the balance sheet accounts calculated. The second thing is what we're going to do is we're going to want to make sure that every single change that we've calculated is accounted for in our cash flow statement. Okay, so for instance, if you look at the second item, it says there's an increase in accounts receivable. If we look up above, we can see that current assets is part of our operating activities. So in this area here, somewhere in here, we would have an increase in increase in accounts receivable. And that's actually going to be, as you can see, there's a $9,000 increase. Now that actually, oops, let me put it over here. And we'll come to this later. That's actually a negative number for purposes of our cash flow. So again, that would fit into the operating activities section. But every single change is going to have to be reflected somewhere in our statement of cash flow. So that at the bottom, when we're finally done, if you look at number 3 here, the result of this, our increase or decrease in cash, in this case, if you look at the change in cash on the balance sheet, we should end up with a $71,500 increase in cash. And that only makes sense because if we've accounted for all the changes except for cash, the arithmetic sum of all those differences except cash, given that our balance sheet's in balance, must equal the change in cash. So if we added up all those differences, the pluses and minuses, except for the cash amount, if we added all those up, we would end up with $71,500. And that's how this is going to work. So we just have to make sure that, first of all, we calculate all the differences, we account for all those differences, and make sure they're somewhere in our cash flow with the correct sign. And then if we do that, the result should be equal to the change in the cash balance from year to year. So that's how this is going to work. That's the way our cash flow is going to be structured. So let me come back and we're going to talk about some basic concepts in terms of how we're going to handle a couple things, how we're going to convert some things into cash flow, in particular the operating activity section, and then we'll go forward and do an example cash flow.